Warren Buffett is considered to be the greatest investor of all time. And every year, he has an annual conference. And at that conference, every word, every sentence, every breath the man takes is highly scrutinized. And at this year's meeting, the attention was focused on Warren's massive cash pile. Yeah, the man has like nearly $200 billion that he's not investing.
This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%.
Even if bonds dropped to paying 1%, he wouldn't invest the money. Lots of people speculating that Warren thinks there's a crash coming. He's buying T-bills and just letting it sit there. And many people are speculating that he knows something. You know, right now with everything going on, I'm pretty paranoid about putting money into the stock market just because. Now, I'm not saying that Warren's paranoid, but the fact that he is not investing money in the stock market does give me pause. Which brings me to the critical issue of retirement. Right now, there are a huge number of baby boomers getting ready to retire. Over 30 million baby boomers are getting ready to turn 65. And these people are relying heavily on the money that they have invested in the stock market. With the market at all-time highs, there is an underlying current of concern out there on exactly what would happen if we did have a crash.
We have to shake this bubble out. They finally went so far in stimulus and reacting to COVID that they caused that 9% inflation spike suddenly. And that's what we saw. And that's when they had to say, we got to reverse and start tightening. What people don't realize, every time they do a major stimulus or a major tightening, you got to wait a year and a half, and I think now as much as 2 years, for that to impact. It takes a while for that to work in the economy. So we felt that stimulus that continued, the strongest in history for 14 years, into March of 2022, that's still been hitting up to recently, and we're going to see this tightening, 525 basis points, the most in over 40 years since the 80-81, which caused the deepest recession after the Great Depression back then. We're yet to see this. We're going to see that hit the most early to mid 2025 next year. So I'm just saying, look, this bubble, which is totally artificial. At least the first one was a natural one. You know, in 2025 to 29 was a natural bubble. There was no stimulus behind that, artificial stimulus per se. So this is new. This has never happened. Governments have never felt the power to just say, well, you know what? We're not going to take a depression after our great bubble and party. We're not going to take the hangover. We're just going to, what do you do if you want to cure a hangover? You drink more.
I mean, if we had a sharp correction, what would it mean to the person that's, one, in retirement, but those getting ready to retire? Would you have to curb your current plans? Would you have to work longer? Would you have to reevaluate how much you were going to spend monthly in your retirement? All of these things are on the top of my mind. All I know is working into your 70s wasn't on my list of things to do. Then when you go in, add all that inflation in what you have saved, well, it's not going to go as far as you originally planned for it to last. You know that financial calculator that we all run, the Monte Carlo simulator? I've run that thing so many times, my eyes could bleed. I just hope it's right. As of 2024, the Dow Jones Industrial Average is hovering near historic highs, recently closing at 38,800 points. This surge is largely driven by the Magnificent Seven, a group of big tech companies, including Apple, Microsoft, and Amazon. Interestingly, the market's buoyancy is mostly propped up by these large cap stocks. These stock giants, despite some of their recent underperformance in their earnings, continue to prop up the stock market. For instance, companies like Tesla and Amazon have reported earnings that didn't meet expectations but remain influential in maintaining high market indices. Now, we all know it's an election year, and common sense would tell you something's just not right. I mean, have you looked at the job numbers? Check out this gem right here. Nearly half of U.S. online job postings are fake. Fake job listings. On top of fake job numbers. And you can look that up. The job numbers quietly get adjusted, always downward. Quietly later, something smells fishy. And it's not the seaweed on the shoreline here in Florida. Obviously, when someone like Warren Buffett refuses to deploy all of his cash, it does tell you that he doesn't think the market's worthy of that investment.
We only swing at pitches we like, and if anybody tried to swing at every pitch, or felt that because they hadn't swung at a pitch for the last two pitches, they ought to swing at the third one or something like that. It isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
Apparently, he's not trusting the science.
When we see this bubble burst, and again, this bubble's been going 14 years instead of most bubbles 5 to 6. It's been stretched higher, longer. So you'd have to expect a bigger crash than we got in 2008 to 9 when the baby boom wore off, in 2000 to 2002 when the first tech bubble, which is more similar. This is really the second tech bubble version. Crashed, and then the NASDAQ went down 78%. I think the Dow, the S&P went down something like 58%. Okay, so that's where we're at. This thing has got to blow. It's showing signs of popping here. It's having a hard time, just barely making new high. But we've got to see a crash of about 40% to say, oh, okay, finally the bubble's let off its steam. And once it gets that much momentum, I think it's hard to stop. And
do you think the market's overinflated? And if so, are you worried about your retirement plans losing 40, 50% of their value in the next 12 months? Or maybe 6 months? You know, I do read your comments, and I would like to know if you're as concerned as I am about what's happening with the stock market and the economy and how it's going to affect your ability to retire. I know I am concerned about it. I mean, I'm just sitting and waiting because I would love to just set it and forget it. But something just isn't sitting right, at least for me. Now, I'm not a financial advisor. I can't tell you what to do with your own money, but I would like to know if I'm the only one out there concerned about this or if this is something that you are pondering as well. Because I am paying attention to what the big boys are doing. And the fact that Buffett is sitting there on all that money, common sense will just tell you there's a reason why.
I'm just telling people, this is not the time to hold out for a little more gains. We've already gotten the longest bubble, the greatest gift. Everybody's house has gone up double or more what it should be worth. Everybody's stock portfolio has gone up double or triple what it should be worth because of all this stimulus. But if you have to pay the piper, which I say and history shows after bubbles, every major bubble is burst. And bubbles are not followed by recessions. They're followed by depressions. When you hear Great Depression or the Long Depression of 1873 to 96, those followed major bubbles. And the other one was the Great Depression of 1836 to 42. That followed a major bubble back then. So bubbles don't end well. And this is the largest and longest bubble. And it's hard for me to fully predict. I have my predictions. I think we're going to see the S&P go down 86% from the top, and the NASDAQ 92%. And a hero stock like NVIDIA, as good as it is, and it is a great company, go down 98% before this is over. That's just my best estimate from the past.
While the current market highs may seem like a golden opportunity to make money, I think it's wise to approach with caution, especially if you're getting ready to retire. Risk tolerance is low. When you're trying to retire in the next 5 years, that's money you need. You know, the goals for most retirees is to have a secure, stable, comfortable retirement without having to ride the waves. The only time I want to ride the wave is when I'm here at the beach, not with my retirement account. Well, I hope I provided another thought-provoking video for you to consider. If you got something out of this video, make sure to give it a thumbs up. Make sure to subscribe if you haven't already done so. I want to thank you for spending part of your day with me. It's greatly appreciated. I enjoy seeing you here, and I hope I see you here again soon. I'm Lisa. This is Living with Lisa. Take care.